Hey, y'all, Canadian Solar released their Q1 2022 earnings report, I believe, yesterday. So today we're going to go over that. Also, we're going to go over any um, HFCAA updates. That's the Holding Foreign Companies Accountable Act, in which Canadian Solar was blacklisted back in early May. So we're going to see if there's any updates in regards to that. And also, we have updates on Canadian Solar's strategy when it comes to developing panels, wafers, and cells. We'll go over that. And then at the end, I'm going to let you know what my thoughts are with the company going forward. So, we're going to start off going to hypercharts.co/CSIQ, ticker symbol. And this will put into visualization their latest earnings report. So here we have the revenue at 1.25 billion, falling slightly from Q4 2021. And year over year looks like it increased by about $200 million or so. Net income coming in at 9.207 million for the quarter, a decrease year over year, and a decrease quarter over quarter. Margins are also falling. Here's the profit margin at 0.73%. Operating expenses came down as well quarter over quarter, but increased year over year. And it looks like selling expenses was the most, so maybe that alludes to shipping. We'll have to see. And research and development holding steady, it looks like. And this will display their growth. The blue being revenue, operating expenses being red, and the year-over-year growth. All right. We'll go to their. Actually, let's jump over to their PowerPoint first. So let's see. Here is their manufacturing capacity outlook. So here's Q4 2021, the actual numbers. And this light color here is the ingots, and the wafers here, the cells here, and the modules here in red. So here's the actuals here, and then for June 2022 estimated, which would be next quarter, starting next quarter. This is, they're going to hold steady on their ingot, wafer, and cell production, but they're going to increase their module production. And then by the end of the year, by Q4 of this year, they should increase ingot, wafer, and cell production, be just about the same. And module production should reflect this. This will increase vertical integration. They won't have to purchase as many ingots, wafers, and cells from other companies. They still have to purchase the what is it? It's polysilicon. They still have to purchase that from outside sources. But as far as the manufactured goods, they will be making in-house. Give them better control over costs, technology, and product quality. And this will allow them to this will give them access to greater margins, improved pricing power, and long-term profitability. So they're going to invest more in manufacturing. That'll increase that operating expense number we were just looking at on the chart in the short term, but it should bring it down or have a negative and an inverse relation between the revenue growth. Let's see what else we got. Here they are addressing some of the concerns in their ESG sustainability report. This is in regards to the HFCAA somewhat. They're talking about the forced labor. They do not tolerate forced labor or any form of modern slavery. So there's the Uyghur region in China. It's predominantly Muslim community, in which China is putting members of this community in forced internment camps, re-education camps, and they've been accused of engaging in slave labor over there. And there's allegations that China's solar producers are exploiting this labor, or the polysilicon suppliers are exporting this labor, in which companies like Canadian Solar, Jinko Solar, JA Solar, other companies like that are either using that labor or importing parts from that region. And so here they are saying that they do not tolerate the forced labor, and they have ESG audits of suppliers, and they mandate from the board to conduct third-party assessments at reasonable cost, quote unquote, and ensure that they are not engaging in any human rights abuses. But who knows? I know the HFCAA implicated, well, the PCAOB implicated Canadian Solar and want to further audit the company, and they're not able to comply with such requests. But we'll get into that a little bit more. But here they are addressing it, and I was going over their quarterly results, and I didn't see any mention of that. So it does pop up here, but in remarks from the CEO and the board, I could not find the HFCAA being directly alluded to. Maybe I missed it, but as far as I know, it wasn't contained there. Here we go. They're saying Q1 is a seasonally softer quarter. And we saw on that chart, the hyper charts, that not necessarily, maybe in terms of their profit margin, but net income typically, I didn't see the correlation there. So they have module shipments of 3.63 gigawatts, storage shipments of 290 megawatt hours, revenue of 1.21 billion, gross margin of 14.5, gross profit of 176 million. Let's see. So the raw material costs still going up, partially offset by shipping and FX improvement. That's a foreign currency exchange rate. So here we have the US dollar compared to the Chinese currency here, and that has plus 7% in 3 weeks. So the value of the RMB increased plus 7% in 3 weeks. And here's the containerized freight index, minus 20% from the peak. And polysilicon price is continuing to increase. So here is their strategy for solar: expand capacity to grow global market share, increase vertical integration to reduce market risk and drive innovation, which we saw with them focusing on ingot, wafer, and cell production by Q4. Doesn't look like they're touching that in Q1, Q2, Q3, but by Q4 they should increase that significantly and grow from lean asset base. And then for their battery storage, execute on the growth strategy, enter new market services, develop competitive, safe, differentiated proprietary technology and product. So they're going to expand the residential and small commercial and industrial offerings through solar battery storage total system solutions. A couple other companies have engaged in this as well. It's very lucrative because you can do both solar and battery all in one, and then manage the management system. You can profit off of that as well. Here's the solar project pipeline in megawatt peak. They're constructing the most here in Latin America. The backlog looks like still have quite a bit here. 2.5 gigawatt peak in Latin America, increasing their construction in North America as well as Middle East and Africa. Japan, yes. Asia, yes. China, currently nothing in construction, but they have a backlog, pretty significant backlog. And this is 95% contracted here. So this number, the pipeline, that is what they wish to construct, but this is what is actually guaranteed. Ordering material, getting ready to construct right here, and they have contracts on it. This is not relevant. Maybe they obtain some of these jobs, but don't count on it. And then for their battery storage project pipeline here, they're constructing 1.4 gigawatt hour in North America, nothing in the other regions. 20 megawatt hours in Asia Pacific, excluding Japan and China. And then next quarter or future quarters, they don't have anything else lined out for North America. 1 gig lined out for Latin America, 56 megawatt hours for Middle East, Europe, and Africa, and then 300 megawatt hours lined up for China. Pipeline is quite large, so there's the demand for the battery storage out there, but just not contracted yet. There are quite a few other companies that engage in the total solution as well. Probably less so than this for the solar project pipeline. This is probably much less competitive. The battery storage pipeline probably much less competitive than the solar project pipeline. Multiple levers of growth, focusing on recurring income. Okay, so the inflection point seems to be here this year. If they can meet their expectations, this year would be the inflection point where they're going to double from last year, the actual number, 2.1 gigawatt peak. They're going to double that to 4.5 gigawatt peak this year. Slightly less than double to 2023. More significantly less than double to 2024. Gradual increase to 2025. Even smaller gradual increase to 2026. So the inflection point is going to be this year going into next year. And let's see, annual project sales gigawatt peak. That's going to be in terms of operational. It's going to be the inflection point. But then in terms of developing, they completed 2.1 gigawatt peak last year, and then they're going to do 2.1 to 2.6 gigawatt peak this year, hopefully, and then 2023 2.8 to 3.3. And so let's see, the inflection point would then be this year, 2023, for their production side. It's where you start to see them steadily increase their production. Here's just a kind of a gradual increase, but we'll see if they'll be able to hit those targets. And then investment vehicles, partial ownership of solar projects. You can see the numbers here. So their plan is to build out all of these energy projects, kind of like a utility scale, around the world, and then operate and maintain them and get recurring income from those. So they make money completing the projects, and then they're going to make residual income selling energy and storing energy and managing the systems for these utility companies or for governments around the world. And they're really diversifying, as you can see, their construction and their battery construction and their backlog here. They're really diversifying where they're going to be around the world. And yeah, all of this will hop over to the other, the 10Q. We'll hop over there and look at that on the 10Q. So the guidance as of May 24th, what? Yesterday? For the future year coming up. So here is Q1 actual, what they're guiding for Q2 2022 guidance, what they're guiding for the rest of the year. Let's see. No. Just the guidance. Oh, for next quarter, right? Because this is Q1. This report is Q1. So this is what they did, what they're going to do next quarter, or what they're guiding to do. Here is all of last year, the actual, and then what they're guiding for all of this year, and then the delta percent, so the change in percentage year over year. Okay, so this quarter, actually, they did 3.63 gigawatts of modules. Battery storage, 290 megawatt hour. No project sales. That's just straight construction this period. Revenue 1.25 billion. Gross margin 14.5. Okay. Next quarter, they're guiding just about 5 gigawatts. Battery storage shipments 600 megawatts plus. Still not completing those projects. And then the revenue, they're planning on basically doubling the revenue. Steady gross margin. And then, so their net income would be pretty much double what it is now, which I think was 9 million. So be 18 million next quarter. And then all of 2021, they shipped 14.5 gigawatts of modules. And this year they are guiding for 20 to 22 gigawatts, which is a change of plus 45%. Battery storage shipments, last year they did 900 megawatt hour. This year they're guiding for double that, and so the percent change is 100%. Project sales, they did 2.1 gigawatts last year. They're going to do 2.1 to 2.6 gigawatts this year, which is a change of 0.10%. That's what I mean by that inflection point up there. They're going to increase this percent change in the future by 2023 is what I think we're saying. And then the revenue, they did 5.3 billion last year. They're planning to do 7 to 7.5 billion this year, which is going to be plus 35%. And then the gross margin last year was 17.2%. Here they're guiding for, they hit 14.5 this quarter. They're planning on about 15% for next quarter. And then they're not guiding for anything because they're really uncertain with the changing cost, shipping, polysilicon, exchange rates, very up and down. So they're not even going to guide for that. But 2 quarters of just about 15%, it's probably going to be less than last year. So even though the revenue will be higher, maybe the net income will be much lower. So let's see. Expect significant growth in Q2 and fiscal year 2022. Q2 growth driven by higher module and battery storage shipments and project sales. Okay. Yep, that's it for this. Close out of that. Let's see. So they shipped, as we went over, 3.63 gigawatts, which was in line with their guidance. 15% increase in revenue year over year to 1.25 billion, which was in line with their guidance. Gross margin of 14.5, in line with their guidance. Net income of 9 million, or 14 cents per diluted share. So if next quarter was it? We said 18 million is probably what they would hit, which would be 28 cents per diluted share. So those 14 cents is pretty low compared to some of the prior quarters, but a 28 cents per share would be kind of in line with what they usually hit. And then global energy storage pipeline of 24 gigawatt peak, storage pipeline of over, you know what, don't even worry about the pipeline. Okay, accelerating upstream capacity expansion plan, which brings me to this article that I found. Canadian Solar unveils photovoltaic manufacturing strategy shift, targeting greater control over upstream supply. So, let's see. Yeah, is basically what we were saying. In the second half of this year, total operating expense costs of about $850 million US. That's what they're spending to increase that ingot, wafer, and cell capacity. And that's not going to happen until after Q3, as we saw. Well, maybe they start to spend it now, but we won't see the results of that until Q4, as we saw in the presentation. And last November, when they reported Q3 2020 results, stated that they were going to hold consistent with... the business said it was halting plans to increase its solar cell capacity, fearing overcapacity in the short term. Okay, well, they're reversing that. Now they're going to do their 20.4 gigawatts of ingot capacity, 20 gigawatts of wafer capacity, 19.8 gigawatts of cell manufacturing output, and then the 32 gigawatts of module capacity, as we saw. And yeah, that's pretty much it. Okay, we went over everything else. Challenging year. It was challenging. The costs. Yeah. And then let's see here. So the net foreign exchange gain in the first quarter of 2022 was $3 million compared to a net gain of $1 million in the fourth quarter of 2021 and a net loss of $7 million in the first quarter of 2021. So you can see how significant the change in the foreign exchange rate impacts the net profitability of the company. And so they had the 9 million net revenue or net income, or 14 cents per diluted share this quarter, compared to net income of 26 million last year, same quarter, or 40 cents per diluted share. So net income of 23 million, 36 cents per diluted share. So that's pretty significant change year over year, 36 to 14. And that will increase the PE ratio of the company, which is not a good thing. And then the total debt was 2.7 billion as of March 31st, 2022, compared to 2.5 billion as of December 31st, 2021. And that's mainly driven by an increase in project financing and working capital facilities. That high of debt, they have more debt than their market cap, but I mean, they have drastically more revenue than their debt. Net income, as we saw, was 9 million. So for the year, if you extrapolate out from that number, it'd be 36 million. So they have quite a bit of debt at the moment. And let's see, we went over their targets, the regions we went over in the PowerPoint, for the storage as well. We know what solar power plants they have in production. And let's see. Okay. Here is financial results. So the net revenue of last year is about 700 million. 700 million. And then this year, 1.2 billion net revenue. And the income from operations was a loss of 52 million last year, and a net net income of 32 million this year, for the trailing 12 months, that is. And so the operating margin was negative 7.6% for the trailing 12 months as of March 31st, 2021, and 2.6% for the trailing 12 months for this March. Pretty significant progress that they made. Let's see. For the second quarter of 2022, the company expects total module shipments to be in the range of 4.9 to 5.1 gigawatts. And that would include 150 megawatts of the company's own projects. Total revenues are expected to be in the range of 2.2 billion to 2.3 billion. All right. Here we go. Recent developments. Let's see. I'm wondering if there is anything addressing. No, there's nothing that addresses the HFCAA allegations against them, which is unfortunate. Here's their assets. So just under $1 billion in cash, which significantly under their 2.3 billion in debt. Yeah, that's pretty much it here. So let's hop over to the SEC update on the HFCAA. So this is kind of like a transcript here. It reads much like a transcript, introducing everything. They're reiterating what we went over already. The PCAOB, kind of going over their claims against the companies we went over in the previous video. There's 80 Chinese companies where the PCAOB cannot gain access to paperwork that they need to audit, and they cannot be produced because they contain national security materials is questionable at best. So they're saying, this is from the SEC.gov website, and they're saying that the Chinese claims and reasoning for withholding the documentations that they're trying to get from these public companies that are trading on the New York Stock Exchange, they're saying that it would violate their national security interests, but the SEC is saying that is questionable. They have doubts. And second, although there have been ongoing and productive discussions, so they're still ongoing, they have been productive, but significant issues remain and time is quickly running out. Even if U.S. and Chinese authorities reach an agreement in the near future to commence PCAOB audit inspections and investigations in China and Hong Kong, such an agreement will only be the start towards satisfying the PCAOB statutory mandate. And finally, should the issuers of the relevant Chinese authorities wish, they can effectuate the voluntary delisting of China-based issuers that they deem too sensitive to comply. So they're pretty much saying there's no reason to withhold all 80 companies' paperwork. The ones that are too sensitive, directly involved in national security, just delist those. Go ahead and delist those, and then we can get on with our inspection. And yeah, and we can avoid potential trading prohibitions in the U.S. Then they go ahead and give you a background of the Securities Act, the evolution of the PCAOB, the HFCAA, and all of that. And so let's see here. First, the HFCAA directs the PCAOB to determine whether it is unable to inspect or investigate completely registered firms located in a foreign jurisdiction because of a position taken by an authority in that jurisdiction. Second, the HFCAA directs the SEC to identify issuers that file annual reports that include an audit report prepared by auditors covered by the PCAOB's determination. Finally, after 3 consecutive years of an issuer being identified by the Commission under the process, the HFCAA requires the SEC to impose a trading prohibition on securities of those issuers. After 3 consecutive years of an issuer being identified. So many of those companies were listed May 20, 2022. So this year, this month, just a couple days ago. And these issuers may face potential trading prohibitions and ultimately delisting as soon as 2024. So that reiterates what we read earlier. And so any claim of national security concerns to justify refusal to provide the PCAOB with audit work papers should be viewed with skepticism. The PCAOB is able to completely inspect and investigate its registered firms in more than 50 other countries. So they are not liking the direction things are going. Time is running out, they reiterate, as we saw. They're actually going to call out some of these. Under this accelerated timeline, almost 200 China-based companies like Alibaba, Yum China, Weibo, JD.com, and Baidu could face a trading prohibition beginning in 2023, when such issuers file their next annual report, which would be around January, February. As discussed above, the situation did not happen overnight. After more than a decade of confidence-building measures and pilots, the PCAOB still faces serious challenges relating to the absence of a workable cooperative agreement between Chinese authorities for a regular cycle of inspections, restricted access to required information, and limitations as to engage selection. An agreement's only the start, so even if they reach an agreement, they still have a long way to go. So here we go. Working backwards from the date of the PCAOB's 2021 determination, allocating a few weeks for PCAOB staff to draft a determination for its board to vote and approve it. That means the PCAOB would need to complete inspection investigations by early November 2022. And so to conclude, significant issues remain even though there's been progress on discussions with China and Hong Kong. Even if an agreement is signed between the PCAOB and Chinese authorities, it's only going to be a first step, so they must be able to obtain sufficient cooperation agreement from the Chinese authorities to make a determination that can inspect and investigate completely in China. And this is not a firm-specific determination, it is a jurisdiction-wide determination. That means that the PCAOB must be able to access audit work papers from all, not some, China-based issuers and the registered public accounting firms. Okay, so some companies, some authorities, some public officials might comply, but all of the Chinese companies listed must comply and must clear all that up, or they need to delist, select, okay, so Baidu, JD.com, we're going to deem these national security interests, we're going to delist those. Now all of the 200, what they say? Last I heard it was 80, but I guess they increased it to 200. Yeah, almost 200. So maybe, Baidu and JD.com are the holdouts in terms of national security, so China needs to go ahead and delist JD.com and Baidu, and then all 198 are in compliance. Boom, now we have an agreement, we can move forward. So it doesn't look like this is clearing up anytime soon, and honestly, that makes, even though Canadian Solar's Q1 2022 report, it was pretty good. They less profitable year over year. I don't really care about profitability in the short term. I see they are planning to increase manufacturing. Fourth quarter of this year, they should be more vertically integrated. They should significantly increase their battery production and deployment, and they should be owning and operating much more energy solutions across the world, and they'll be in a very good place. And so I don't care about the profitability being down, as long as they are still profitable. However, this is very hard to look beyond. I don't know if they do get delisted. I don't really know what that looks like. I would think that we'd be unable to sell our shares in that event, or unable to trade our shares. I'm not sure if they get dissolved, or I've never witnessed anything like that happening, but I would imagine that's pretty much as good as gone at that point. So, for that reason, this news here with the potential delisting makes me extremely nervous, and that makes me want to look for opportunities to hedge my position, sell out of the position slowly, which is kind of upsetting because I've done a lot of research into this company and I like their vision, their direction, and definitely have believed in the company for a long time. So I hate to see it go. However, yeah, what do you do? Tricky situation. But we continue to monitor it, and we'll see if it gets any better. In the meantime, between now and the next quarter, I definitely look for opportunities to sell some shares, and I'll continue to monitor it, see if things improve or get worse, and let me know what you think. Help give some guidance on this, and thanks for watching.